Historic times in the silver market. Hello and welcome back to the Northern Miner Podcast. My name's Adrian Pocobelli. Happy holidays, happy new year. Final show of 2025. What a year it has been. What a week. I hope you enjoyed your Christmas. For those that are involved in precious metals, it must have been particularly exciting, perhaps too exciting. When you're in a bull market, it can be hard to concentrate. When you're seeing, your investments go through the roof, I hope all you investors out there in precious metals were able to concentrate on your family and not refresh your phone to see the latest gains in your portfolio. So incredible, historic moves in the silver market in particular. But I was looking at CNBC. I think I saw platinum and palladium at one point up, 14, 15% in 24 hours. Right around Christmas. Silver was not far behind. I think I saw 11, 12% at one point. I think it broke $80. And now is at $75 after getting knocked down 10% to $70 yesterday. So, quite a dramatic week here. In the precious metals market, there is all sorts of talk as to what is going on. For silver, as someone who's been paying attention to precious metals since about 2010, 2009 even. This has been a silver and gold bugs prediction, one could argue, of what could happen in this market, particularly in the silver market, where it has been discussed literally for at least 15 years. I can say anecdotally, based on my own listening experience, that silver is going to go crazy. Silver has gone crazy. And what's interesting is perhaps this isn't over, and we had a big drawdown yesterday, down 10% on new margin requirements from the CME. Now, this is interesting because this is something we often see at the CME when a market gets out of hand. This is not the first time, and actually I have a Wall Street Journal article. Let's just turn to this first. And this is from December 29th, so yesterday. At 10:22 Eastern Time, exchange operator CME Group hit the brakes on last week's wild rally in gold and silver futures by requiring traders to put down more cash on their bets. Gold futures dropped 4% in morning trading, while silver futures slid 7% after touching a record intraday high overnight. Scrolling down, platinum and palladium futures were also affected by CME's move. They dropped 13 and 16% respectively in morning trading. I mean, these are some pretty dramatic moves here. The words that go through my head, I believe it's mentioned in the panel, actually, that's going to be on this week's episode. We have John McCluskey, Rick Rule, and Rob McEwen in London discussing where gold is going to next. I am moderating. It's a wonderful discussion. That is coming up. Your holiday specials continue here. Very insightful, by the way, for those gold stock investors, some things to consider. So I encourage you to listen to that. But what I think to myself, I believe it's mentioned in this discussion, is the purpose of a bull market is to knock you off the bull market. And I think we're seeing that here. Today, we have a recovery of sorts, up 5% on silver, up to $74.05. I would say a pretty nice bounce. Platinum, 2%, copper, 2%, $5.67 on the futures. And you wonder to yourself about the timing on this, happening over Christmas, and all sorts of causes are being attributed to this. Perhaps the most mysterious is this notion that Shanghai has a premium on silver. And we're seeing talk of export restrictions being brought in on January 1st by China. And this sounds like sensational, head-turning news. Wow, China's bringing in silver restrictions on silver as silver starts to explode. But actually, this was something that was discussed back in October. I have an article from The Guardian that discusses Elon Musk, and here's Elon Musk's tweet. This is not good. Silver is needed in many industrial processes. That's December 27th. And The Guardian puts out an article. Elon Musk warns of record silver prices before China limits exports. As it says, new restrictions on silver exports from China, which begin on the 1st of January, have created supply fears, while geopolitical worries have lifted demand for safe haven assets. Now, what's interesting about this is it links to a Global Times article where you see this announcement from the Ministry of Commerce. Basically, the Global Times is reporting on this announcement from the Chinese Ministry of Commerce, also known as MOFCOM. And so this is from October 30th. Chinese Ministry of Commerce, MOFCOM, has issued new rules governing the state-traded exports of tungsten, antimony, and silver exports for 2026-2027, with the aim to step up the protection of resources and the environment, according to a statement published on MOFCOM's website on Thursday. The new rules specified the requirement for domestic manufacturers and traders that want to apply for export qualifications, including credit loan quotas and 2022 to 2024 exports that exceeded designated levels. They also detailed the application process, ensuring that only qualified and responsible companies are granted export rights. For exports classified as high-technology products, the standards can be lowered, it said. Now, interestingly, we're not seeing mainstream media outlets that I can find reporting on the Chinese export restrictions other than The Guardian, linking to an October 30th article. So I find that just kind of interesting in itself. I'm not saying it's not true, but I'm just saying there's a remarkable lack of confirmation here on this story. If the best The Guardian can do is that vague article that I just read to you from the Global Times from October 30th, I'm sure it will come out in the future, and it's probably true. It's being treated as true. Interestingly, it's almost like the internet has created a story that it's now looking for the facts for. So just an observation for what that's worth. And another interesting story that we're not seeing a ton of talk about, which seems central to this whole discussion, is this notion that Shanghai has a huge premium on silver, where you're hearing stories of it being 10% higher in Shanghai to buy silver. So there should be some huge arbitrage. Like, why isn't the Wall Street Journal mentioning this? Let's go to CNBC. This is Tuesday, December 30th, this morning. Let's see if we get any insight here, or is it simply price action? Gold bounces back from 2-week low, silver recovers. So we're seeing a bounce off of yesterday's, what's sometimes being called profit taking or CME margin requirement increase, wiping out a lot of leverage. Gold rose on Tuesday to recover from a 2-week low hit in the previous session on year-end profit taking that sparked a broad pullback in precious metals from earlier peaks. Spot gold was up 0.7% to $4,363 per ounce after hitting a record high of $4,549.71 on Friday. It fell to its lowest since December 17th on Monday, also its sharpest daily loss since October 21st. And this is the thing. With the big pullback, its sharpest daily loss since October 21st, all that happened is it returned to December 17th levels. And we have a quote from Kelvin Wong, senior market analyst at Owenda. Quote, "The earlier run was overextended in the last 1 week or so, which makes the precious metals much more vulnerable for the leveraged long positions being squeezed on the downside." Spot silver was up 3% at $74.41 per ounce after hitting an all-time high of $83.62 in the previous session. Silver registered its biggest daily loss since August 11th, 2020 on Monday. Silver has gained 154% year-to-date, far outpacing gold, propelled by its designation on the critical U.S. minerals list, supply constraints, and low inventories amid rising industrial and investment demand. Quote, "I'm expecting the longer-term rally to continue for both gold and silver, with price targets in the next 6 months at $5,010 for gold and $90.90 for silver." You know what I'm seeing here is a remarkable disparity between what is being discussed on Twitter and what is being discussed in, major media outlets. And perhaps the reason is because a lot of major media outlets, frankly, are on holidays. I felt kind of bad. I worked through the holidays for years now. I've never missed a show. Interestingly, we've never had Christmas on a Tuesday, so I probably would take that one off, or maybe I'd do it on a Monday. But all to say, I kind of felt bad for the news staff at mining.com and Northern Miner The news never stops, and they just want to take a break, and all of a sudden they're having historic price action. How can you not, report on this? So big happy holidays to all of the very hardworking people at the Northern Miner Group across the board. So margin requirements put in and price recovering. Now we have another story here. This is by a staff writer at mining.com. And scrolling down, we have some more discussion on cause. Silver's rally has been gaining momentum since the end of November as a perfect storm of factors, including a Federal Reserve interest rate cut, a healthy demand outlook, and concerns over supply shortages drove prices higher. The metal's last big run came during the historic squeeze in London in October that eroded global inventories. While London's vaults have seen significant inflows since then, much of the world's available silver remains in New York as traders wait for the outcome of a U.S. probe that could lead to tariffs or other trade restrictions. Earlier this month, a Chinese fund warned that investors could be exposed to heavy losses should silver's bull market suddenly turn. The fund's premium ballooned last week to more than 60% over the value of its underlying assets. Looking ahead, market participants, especially those in Asia, see higher upside for the metal. Quote, silver could quite feasibly be trading in the $90 to $100 range next year, while supply shortfalls remain an overarching theme for the precious metals market, said Tim Waterer, chief market analyst at KCM Trade, with files from Bloomberg. So it's going to be interesting to let the smoke clear on this whole situation. How big of a deal are these export restrictions on silver announced back in October that are being treated as if they are new news stories on, say, X or on YouTube, right? Again, I'm looking for the source. It's like the internet has its own story that it's looking to confirm in reality. And there may be a confirmation. It looks like a loose confirmation. Interestingly, in that Global Times article, I didn't see a date put on silver. It just vaguely was mentioning the years, so maybe there's an assumption, an inference perhaps, on these export restrictions starting January 1st, because that's 2026. And the other part of this story is antimony and tungsten. Antimony especially important for ballistics, which, as I discussed last year at the Vancouver Resource Investment Conference, there's a relationship between the hardness of a metal and its use in military application. If you go back in history, bronze was stronger than copper. And the people with bronze, which is an alloy, in other words, copper mixed with tin, to fortify it and make it less malleable than copper on its own, those people, the bronze people, dominated. They had stronger armor, and just as we saw with the Iron Age, following the Bronze Age, that was stronger than bronze. So the basic conclusion you can come to there, a simple one, a thesis, is that the harder the metal, the better. For example, if your ammunition is weaker than the armor of the other side, that's an advantage for the other side. If your bullets can't pierce that armor. So it's not insignificant when you see metals like antimony, or perhaps even tungsten, being restricted. So it seems like interesting stories are coming out. I think we need to let the smoke clear. And that'll probably happen after the holidays when reporters are back at their desk, 8 hours or more per day. We're not seeing evidence to the contrary on either the export restrictions or the premiums. So China potentially once again playing a central role in the metals markets. Another very interesting column here. This is a commentary from Andy Holm at Reuters. Every mineral is critical in the new metals age. The U.S. Geological Survey's updated critical minerals list now encompasses 60 different materials, representing around 80% of all mined commodities on the periodic table. Some are well-known industrial inputs such as copper, nickel, and zinc. Many are not. Among the rare earth elements are exotic metals such as gadolinium, ytterbium, and praseodymium. Now, I have a word for these, more exotic metals. I call them specialty minerals, which I think works actually quite well in the sense that all metals are critical. Not all metals are necessarily what we'd call specialty minerals. Is nickel a specialty mineral? No. Is it critical? Yes. As it continues, from aluminum through to zirconium, all are considered, quote, essential for national security, economic stability, and supply chain resilience, according to the USGS. The spectrum of metals now deemed, quote, vital to American economy, end quote, speaks to a quiet revolution in how metals are used, one nurtured more in the laboratory than in the blast furnace. A very interesting sentence. And it does speak to this wider theme where metals, the most rudimentary of industrial sectors, one could argue, mining, taking metal out of the earth, one of the most ancient, if not the most ancient, sector of the economy, right up there with agriculture. And one could argue, probably weapons probably came before food, and how do you do agriculture without metal? Perhaps with wood, who knows? So we're seeing, again, metals return to form, taking their proper place after being in a demoted position for decades, taking their proper place alongside technology and seen as crucial. And even the flip side of the coin of technology, many critical minerals are, quote, spice metals, used in only tiny quantities but with a transformative impact. I'm kind of back to specialty minerals. Consider, for example, the humble semiconductor chip, the foundation stone of modern technology, ubiquitous but unseen in our laptops, mobile phones, and cars. Silicon has been the wafer of choice for decades, but is close to its technical limits when it comes to advanced computing. Sprinkle in a dash of gallium and germanium, however, and the chip's capacity rises exponentially. So, very interesting discussion from Andy Holmes at Reuters. Continuing on, we have a story in foreign policy. Critical minerals breakout year. Trump's quest for China-free supply chains explained much of his foreign policy in 2025. I've been calling the rare earth story the story of 2025. I'm starting to wonder if foreign policy is starting to agree. And this is by Amelia Lester, a deputy editor at Foreign Policy. This year might be remembered as the one in which critical minerals took center stage. Of the 50 or so raw materials that comprise the building blocks of the U.S. defense and energy sectors, U.S. President Donald Trump has yet to come across one that he doesn't like. In fact, as Foreign Policy's Christina Liu observed, critical minerals are the through line of Trump's second term, and access to them has shaped his geographic fixations and alliances. So Foreign Policy looking back on the year, and the preeminent significance of metal within the larger machinations of the global geopolitical narrative. Now, another interesting development here. U.S. rare earth buyers still see China curbs despite Trump deal. This is Bloomberg News on December 24th. So for all of the song and dance that things are returning to normal with rare earth exports to the United States from China, that doesn't seem to be the case. China is still restricting the rare earth elements that the U.S. needs to produce its own permanent magnets and other products, even after President Donald Trump reached a deal with his Chinese counterpart in October to lift restrictions on the supplies, according to market participants. More than a dozen consumers, producers, government officials, and trade experts said that while China has boosted deliveries of finished products, primarily permanent magnets, the U.S. industry remains unable to acquire the inputs needed to make those items on its own, a key priority for the administration. The people asked not to be identified discussing matters that aren't public. Now, this brings back an issue I was bringing up last week. When we talk about rare earth exports, I'd say it borders on meaningless, because we don't know what that means. Are you talking about the heavy rare earths? Are you talking about finished magnets? There's a huge difference here. And just as we were seeing for months that China exports 90% of the world's rare earths, this is misleading. And we saw it pretty much across the board. The reality is the heavy rare earths are the bottleneck, and that they control 98 to 99% of them. That is the issue. So when we see, rare earth exports down, I'd argue it's meaningless until we know what that means. What does that mean? And I wonder, is China, are they exploiting this ambiguity? Because you scroll down, a spokesperson with Chinese Commerce Ministry said on Thursday that fluctuation in monthly trade data is normal, adding the country is committed to maintaining the stability of global supply chains. Beijing has said it's already approved some application for rare earth exports, but continues to restrict supplies that could go to military contractors. And then you see an image from the China Customs General Administration, and it's titled China's Exports of Rare Earth Magnets to U.S. Rebound. Supplies of magnets to the U.S. recovered after limits imposed in April 2025. I mean, it's hilarious to a certain degree. Is this all semantics? It's like, hey, we're sending you more rare earths than ever. What's the problem? Here are your magnets. But if you're looking for samarium or praseodymium, sorry. But hey, exports are up. What are you complaining about? You have all the magnets that you need. As it says, industry officials and market participants said the reality is different for U.S. players. Quote, people aren't getting materials out of China. You're not getting dysprosium, metal, or oxide if you're a U.S. entity. Scott Dunn, the chief executive of Novion Magnetics, said in an interview, citing his contacts with others in the industry. Novion is one of just a few U.S. makers of permanent magnets. The company doesn't buy rare earth inputs from China, but Dunn said some of his customers do. Quote, outside of China, the world can produce 50,000 tons of magnets, but there isn't even close to the equivalent in rare earth minerals to support those tons outside of China. China restricts materials far beyond what it restricts in magnets to keep that dynamic in place. To be sure, Beijing's easing of restrictions on products like magnets made from rare earths has, for the moment, removed the risks that consuming industries like autos and technology might have to shut down production, according to Gracelyn Bhaskaran, director of the Critical Minerals Security Program at the Center for Strategic and International Studies in Washington. Quote, given we import further down the supply chain, companies don't feel that interruption nearly as much. Because we import more magnets, the impact is much softer. So quite interesting, and as this is all happening, we have military exercises practicing a blockade of Taiwan. And that is on December 29th, 2025, so yesterday. And we see in the Global Times here, the military exercises are called Justice Mission 2025. And you see the blockade, it's quite something. Apparently live fire ammunition was used. Now, another interesting detail. I came across this story from December 9th, China's Critical Minerals Strategy in Africa. This is from the Africa Center for Strategic Studies. And according to this article on africacenter.org, it has China's mine to rail, road, and port corridors in the DRC. And you look at the Libido port in Angola, of course, much celebrated by the West as the way that we're going to get critical minerals out of the DRC. And you look at who owns the Libido port. China International Trust Investment Corporation, or CITIC, Construction Group, and Shandong Port Group hold a 20-year concession for port operations. So that port in Libido is actually owned by China, according to this article. That is quite interesting. Just a few more headlines. This is the New York Times. U.S. takes a step towards approving seabed mining in international waters. And again, this is the New York Times. The federal government said it would hold hearings next month on controversial applications to mine the ocean floor. Of course, one thinks of the metals company and Gerard Barron, who we've had on this show, and the metals company is aggressively pursuing this within the United States jurisdiction because they have not signed the Treaty of the International Seabed Authority. Because they haven't signed it, this is seen as a legal way of being able to mine the deep sea floor because they never agreed to anything. So quite interesting. Finally, in regard to this missing uranium out of Niger, I mean, one could argue part of the main justification of the Iraq War in 2003 was missing yellowcake uranium in Niger. And here we're hardly getting a discussion of missing uranium in Niger. Now, we heard last week the Paris prosecutors were opening a case against Niger about this missing uranium. And we have an update from financialafrique.com. Niger reaffirms its sovereignty over Somaïr's uranium. And this is by Mamadou Aliou Diallo. Nigerian authorities rejected any accusation of theft regarding uranium on Saturday, December 27, 2025. They emphasized that Somaïr was nationalized in June and that the extracted uranium is now under state control. The military regime in power since July 2023 asserts its sovereignty over the country's mineral resources. So it continues over there in Niger. So a big show ahead of us here. We have an excellent discussion. Gold, where does it go from here? From the International Metals Symposium in London. Rob McEwen, Rick Rule, and John McCluskey, an all-star panel on where gold is going. And also coming up this episode, we have a spotlight interview with Eloro Resources CEO Tom Larson, who discusses the company's Iska project in Bolivia, where if you're interested in tin and silver, this is one you're going to want to hear. If you want to find us online, you can find us at northernminer.com. You can find us on X at northernminer. Find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Tom Larson, CEO of Eloro Resources, for this week's Spotlight. Joining us today, I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Tom Larson, Chairman and CEO of Eloro Resources. Tom, welcome to the show.
Well, thank you for having me. Looking forward to this interview.
As am I, Tom. Of course, Eloro is working out of Bolivia, a very interesting part of the world. But before we get into that, for those that are unfamiliar with Eloro Resources, could you give us a little bit of background on the company and what you are up to at Eloro Resources?
Yeah, Eloro Resources is an emerging exploration development type company, publicly traded on the TSX, was on TSXV, graduated to the TSX a couple of years ago. And its primary focus is the Iska silver, tin, zinc, lead, polymetallic deposit in the southern part of Bolivia on what they call the Bolivian tin porphyry tin belt, a major feeder system primarily of tin that we've been involved with since actually 2020. Started in January of 2020 with the lock-in of the definitive property agreement. The company itself, prior to that, involved and still has a property, 90 square kilometer property, sort of a low sulfidic type gold copper prospect in the Department of Ancash in sort of north central Peru. The company worked on that property for a number of years, 3-4 years, but just found the rather difficult with some of the community issues, in our case, working in Peru, trying to get things done, and then basically had an opportunity to move forward with this Bolivian project. So this is where we've focused in and have raised over $70 million primarily in drilling over 130,000 meters to date, and have outlined a major endowment of significant silver, tin, lead, zinc metals.
It's fascinating. And of course, tin is a pretty interesting metal right now with everything that you see going on in that market. It seems to have the wind in its sails, so to speak. So how would you characterize the project then? I mean, is it, half silver, half tin, or like 30% silver, 30% tin? How should people think about the Iska project in terms of the composition of this thing?
Yeah, so I think the best thing, and I'll describe that, I'm not a geologist, I'm more of a finance guy. However, I've been with very smart geoscientists, primarily Dr. Osvaldo Arce, who found this project and recommended it to us back in 2019 when we were, kicking our heels a bit in having some issues in Peru on the La Victoria property. So the best way to look at this is if you go to our website, elororesources.com, and just take a look and just get a feel as to, there's a couple of really good videos, some good corporate presentations, gives you a bit of an understanding. The bottom line, though, is that this is a volcanic structure. It's a volcanic edifice that basically was formed over 12 million years ago and fed through this, what we call this tin porphyry system. You have copper porphyry systems along the Pacific, South American coastline, Argentina, Chile, up through Peru, Ecuador. In this case, it's a tin porphyry, which is rather unique. And it runs 1,000 kilometers from the border of Bolivia, Argentina, southern border of Bolivia, and directly northwest, right into southeastern Peru, where the active San Rafael tin operation is ongoing, owned by a company called Minsur SA. And tin is a very, very unique metal. They deem it as the glue of metals. You always associate tin with tin cans. And there is still a lot of demand for that type of product, for food preservation and such. But it's really become more of it's replaced lead more so in soldering purposes for circuitry, a lot of like automotive, anything that needs a circuit board, semiconductors, anything that needs that type of soldering, industrial use. Tin also has really become well recognized for. There are many applications now for tin. There's a sodium ion battery that's becoming quite advanced where there's a lot of tin that's used for that type of battery application. So tin, it's a small market. There's only 300,000 tons roughly that's produced annually. And for instance, when I mentioned the tin belt in Bolivia, there's only two active major tin operations. We're located, the Isca project would be located about 40 kilometers south of a major tin operation called Choroque, owned by the state, and also then the San Rafael, which is at the top of the Bolivian tin belt that actually runs into southeastern Peru. Between those two operations, for instance, they might produce 8% of annual tin production. Again, 300,000 tons of tin. So they would produce 25 to 30,000 tons per annum of tin concentrates. Tight market.
So a very tight market. So where are you in this project then? Are you drilling it out? Where are you in the journey of the Isca property?
So we picked the property up, locked it in just before COVID in January of 2020. It had never been drilled. Basically a collapsed caldera center, resurgent, collapsed over, millennia, and started with some adit drilling. There were some old historic adits that the private owners that picked it up a number of years ago. Private ownership's all important, especially when the Mass Party were running the country, which is no longer, thank God. But we started in on a first pass drilling phase in August of 2020 during COVID. And since that point, every single hole we've drilled has been mineralized. It just shows you the extent of this mineralized system, to the point that in 2023, September, we came out with our first pass MRE, which is a 43-101 inferred resource, over 600 million tons, basically mineralization equated to around 1.1 billion ounces of silver equivalent, which is like 16 million ounces of gold equivalent in situ, in the ground. The thing is, though, very wide spacings all the way down to outline this type of system under the center of the volcano, and it's all well documented on the website. But people thought the grade seemed rather low on the silver side. So since then, we've been doing what they call 50-meter spacings, infill drilling, which will be applied for our first pass PEA, slated for the second quarter of 2026. So that's been really the focus: infill drilling, proving up higher grade silver, higher grade tin to the west side of the pit area. The strike length's over 1,000 meters, so, by 600 width, by 500 depth. So, it's a big system, a big footprint. Why we're quite, comfortable with this is that there's an operation 180 kilometers due west of us, similar type of system without being on the tin belt. So they lack tin, but they had silver, lead, zinc primarily. More like a zinc operation with silver byproduct and lead, called San Cristobal, and it was owned by Sumitomo, the trading arm of Japan, private company. But they were running at 50,000 tons a day. They spent over $1.1 billion in 2006 US dollars to build it out. After 2 years prior to that, they came out with their feasibility study. It was only 250 million tons of around 40 grams silver, 1.5% zinc average, and 0.8 lead percent per ton. So we have something that's very similar, and we're following that model. We've actually signed an NDA with San Cristobal because it's now run by an American group, Dr. Quinton Hennig, who's a top advisor to Aloro. He brought in the first money with me in 2020 to finance the initial, never before drilled program at Isca. So that's basically where we sit.
Okay, excellent. So you mentioned Bolivia and the environment there, the political environment changing. If you can connect that to your roadmap and where you see things going from here, what is going on in Bolivia and how does it impact your project?
There's been wide media coverage on what's gone on in the last 6 months. I think most of your audience will know what's happening there, a lot of them, in that, there's a center to right wing government that's taken over, Paz Rodriguez Pereira, who's now the new president, came in October. It was formerly run by the MAS Party. It was a socialist movement party, very left wing, very anti American, Western society per se, very ingrained in their own sort of socialistic ways and very, very sympathetic to the likes of Russians, Chinese, such that, it was very hard for big balance sheet foreign companies to get their heads wrapped around investing during those days. The MAS Party in 2006, when they first became involved in the country. And there's no mystery to the fact that Bolivia has been mining for the last 5, 6 centuries. That's well known for its high grade silver, tin, especially. And this was the opportunity that Dr. Osvaldo Arce found with us, a dormant volcano that reminded him of Cerro Rico, the largest silver producer since the 16th century, over 2.4 billion ounces of silver produced, another major 15 million year volcanic edifice. So the bottom line with the government, the left-wing government, that really were very popular because there was a big oil discoveries, gas discoveries, and so that flowed down to the masses, and that kept the country happy for a number of years. And it also benefited us, even though we weren't around at that point, back in the 2010 to 2015 range, 18 range, they built out a lot of infrastructure. So there's a lot of good roads, paved roads, and hydro and power, especially, we're 25 kilometers away from the rail that'll take our concentrates to port down on the Chilean side of things. But when that sort of dried up, then monies became scarce, fuel shortages, and that turmoil really kept driving for about 3 or 4 years, to the point that people just finally said enough's enough. They saw what was going on in Argentina, what just happened in Chile, all these sort of right-wing parties now emerging down in South America. So Bolivia basically knew that to get, basic mining's about 40%, 35, 40% of their GDP. So to really get that moving, they need foreign capital for big projects, mining projects. The incoming government realized that, and that's the environment we're now in, having worked through this for the last, since 2020. So we're sitting in a pretty nice situation whereby, first of all, the US are reopening an embassy. They were told to leave in 2006 or 2007. Israel just opened up an embassy. I see, with the thirst for critical metals, like for instance, tin, there's no source of tin other than in Bolivia in the Western Hemisphere. It all comes primarily from Myanmar, Indonesia, China. And so the Americans, for instance, and Western Europe want to become a little more independent and find more domestic, local Western sources of things like tin, critical metal. So we're sitting in a pretty interesting situation at this stage, and that we can be thankful for with this pro-Western government that's now in place in Bolivia. The MAS Party are down to almost less than 3% of the popular vote. They almost lost their political charter. They have zero representation in Congress. So it was just a landslide. So to say the least, we're quite pleased. And in fact, my head of geology, Dr. Osvaldo Arce, that oversees the project, over 100 people working under him, all Bolivian, geologists, graduates, people that have, drilling. He phoned me this morning and mentioned that he is with the mines minister. Things are moving quickly. He is with the mines minister, who he's known, the incoming mines minister, who he's known for over 30 years. These are all very, very helpful. Bolivia, again, is a small place. If you have a very sound reputation, like he does, for instance, things can move quickly. One of our directors, Pablo Ardane, is also one of the head mining partners for PPO, the largest law firm in Bolivia. So yeah, we're getting pretty comfortable with what's going on.
Okay, excellent. And just in a couple of lines, if you can, Tom, what is it that you want investors to know about Iloro Resources? What do you want them to take away from this conversation? Boil it down for us.
Basically, that we found a source of silver, tin, zinc with indium that we believe we can turn into a solid economic commercial project. And we're working towards that. We feel we'll have a feasibility study in the next 12 to 14 months. It's just coming from the fact that it will be not only helpful for the communities in Bolivia, southern Bolivia, but it could be also helpful for the likes of Western countries, because we're dealing with a massive system here. It's not some small little mining operation that might have a 10-year mine life. So my point being that if you're worried about, hyperinflation or the devaluation of currencies that obviously has been taking place, silver's tripled in the last year, so there's reasons.
Tom Larson, Chairman and CEO of Iloro Resources. Thank you for joining us and telling us everything that you're working on at the company.
Thanks, Adrian.
Thank you once again to Iloro Resources for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit ilororesources.com. Turning to the website, A Record in Copper. And this is by Henry Lazenby at the Northern Miner. Copper nears $13,000 as tariffs, outages tighten supply. Copper climbed to fresh records in London trading, edging towards $13,000 per ton, as tariff risk pulled metal into the United States just as mine disruptions and low inventories squeezed the rest of the market. LME copper touched $12,742 a ton overnight, and this is written December 29th, before easing to about $12,421, still up 39% this year, SP Angel analyst John Mayer said Monday in a note. COMEX futures fell 2.5% after rallying about 6% in the prior session, leaving U.S. prices at a premium to London. The widening gap matters because it is reshaping trade flows. Tariff worries have encouraged buyers to front-load shipments to the U.S., Mayer said, helping draw about 400,000 tons into COMEX warehouses and tightening availability in high-demand Asian regions. Copper is mining's clearest real economy bellwether. Sustained prices near records can speed up project timelines and permitting pressure, lift scrap supply and force manufacturers to test substitution, often with aluminum, though many electrical and industrial uses have few workable alternatives. So, big moves in the copper market, again, waiting for the smoke to clear as to what is actually going on here. You're hearing more talk of Shanghai offering a premium and how long this will last and how significant this is in boosting copper prices. I mean, it feeds into a whole narrative, largely a gold bug narrative, that China is slowly taking control of the metals markets and the pricing action of the metals markets, and they're doing it through physical, is the underlying narrative. Continuing on, SolGold agrees to $1.2 billion takeover by top investor Jiangxi Copper. This is by Reuters on Christmas Eve on mining.com. Gold and copper miner SolGold said on Wednesday it had agreed to be acquired by its largest shareholder, Jiangxi Copper, in a deal valuing it at $1.17 billion. The agreement gives Jiangxi control of SolGold's Cascabel project in Ecuador's Imbabura province as miners race to secure copper supplies amid rising demand driven by electric vehicle and AI infrastructure investments. The region is home to one of the world's largest undeveloped copper-gold deposits in South America. I mean, it just continues. For all of the song and dance from Western policymakers, there goes another one. There goes another one. And this one seems like a pretty big one. You know, for all the talk of Monroe Doctrine right in the U.S.'s backyard. So one would think they would be jumping all over it. And what did it go for? For $1 billion. And if China overpaid, who cares? What's $1 billion today for a major copper-gold project? This went for a 43% premium to Ecuador-focused SolGold's closing price on November 19th. Okay, so they paid 43%. Where's copper going to be in a year? Where's copper going to be in 3 years? Sounds like a pretty good deal to me. Continuing on, iron ore price nears best close since November on year-end metal rally. This is Bloomberg News via mining.com on December 29th. Iron ore futures were set for their highest close since late November, riding a broader year-end rally in metals as traders look ahead to potential policy support from Beijing. The steelmaking ingredient advanced for a third straight session in Singapore, climbing nearly 1.8% to as much as $106.55 a ton in intraday trading. In China, iron ore on the Dalian Commodity Exchange rose for a second day, gaining as much as 2.6%, the largest intraday rise since September 9th. The rally comes amid a broader surge across metals, with copper hitting an all-time high and silver smashing past $80 an ounce for the first time. Market sentiment was also boosted by China's latest call to support resource-based industries as part of its so-called supply-side reform program. The National Development and Reform Commission said Friday it would deepen these reforms in steel, petrochemicals, and similar sectors as part of China's 15th five-year plan from 2026. This would include the expansion of high-end production while prohibiting unauthorized capacity additions and using market mechanisms to encourage consolidation, it said. China will also expand government spending and improve how it deploys capital in 2026, the Ministry of Finance said on Sunday after a year-end policy meeting. Monday's gains defied a buildup of iron ore stockpiles at Chinese ports, the 10th increase in 11 weeks, to the highest level in more than a year, according to data from Shanghai Steelhome E-Commerce Co. This underscores that the latest rally is being driven by futures sentiment rather than a clear improvement in physical demand. Iron ore prices have been resilient in recent months, with a ban on some supplies from BHP Group by China's state-backed iron ore trader helping to provide support. That's despite the market fundamentals being weakened by softening steel demand in China. So it seems like China just continues to run circles around the West's, metals-making policy. Continuing on, Axis sues Guinea for $29 billion over bauxite permit revocation. This is by Cecilia Jamazmi at mining.com. United Arab Emirates-based bauxite producer Axis International has filed a $29 billion arbitration claim against Guinea at a World Bank tribunal after the government revoked its mining permit earlier this year. Axis lodged the case with the International Center for the Settlement of Investment Disputes, saying Guinea unlawfully terminated its rights as part of a wider crackdown on mining licenses under President Mamadi Doumbouya's military government. The revocation was one of more than 50 permits canceled in May for alleged non-compliance with the mining code, a move aimed at boosting state revenue and expanding local processing. Axis said Guinea ignored repeated efforts to settle the dispute and wrongly claimed the mine was idle or underused. So the UAE's Axis International responding after quite a delay there. Another Guinea-related story, Guinea's military leader set to extend rule amid mining boom. It's Bloomberg News on December 29th. Guineans voted on Sunday in their first election since a 2021 coup, with the military junta's leader poised to extend his rule amid a mining boom. Mamadi Doumbouya faced off against a fragmented opposition, and advisory firm Control Risks sees none of the 8 other contenders posing a serious threat to him securing a first-round victory. Scrolling down, quote, voter turnout was over 60% in the polling stations I visited in Conakry. Dinabu Toure Camara, managing director of the General Directorate of Elections, told reporters in the capital. Quote, no incidents have been reported that could affect the transparency and credibility of the election. Those are your news stories. Now, let's take a look at metal prices. Turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.12%. That is down 0.03% on the week. The UK 10-year gilt is also lower at 4.5%. That is down 0.01% on the week. Italy's 10-year bond is also lower at 3.48%. That is down 0.04% on the week. France's 10-year bond is yielding 3.54%. That is down 0.03% on the week. Germany's 10-year Bund is yielding 2.84%. That is down 0.03% on the week. Japan's 10-year bond is higher, bucking the trend, and that is at 2.07%, and that is 0.04% higher on the week. So the relentless climb in the Japanese 10-year bond yield continues. China's 10-year bond is also higher at 1.87%. That is 0.04% higher on the week. Turning to precious metals, gold is trading at $4,375.30 per ounce. That is $146 lower than last week, so gold taking a breather. Silver is trading at $73.83 per ounce. That is $4.26 higher than last week, so silver moving higher on the week despite the correction. Platinum is trading at $2,102 even. That is $6 higher on the week. And palladium is trading at $1,658.50 per ounce. That is $135 lower. So on the week, palladium correcting the most. Turning to industrial metals, copper is trading at $5.50 per pound. That is 7 cents higher on the week. Iron ore is trading at $106.99 per metric ton. That is 7 cents higher on the week. Aluminum is unchanged at $1.34 per pound. Lead is higher at 91 cents per pound. That is 2 cents higher on the week. Nickel is back above $7 at $7.14 per pound. That is 21 cents higher on the week, after perhaps bottoming out 2 weeks ago at $6.48 per pound. It's going to be interesting to watch, with nickel being so low and the opportunities in the metals fleeting. Will nickel take its turn? Tin is trading at $19.42 per pound. That is 19 cents lower than last week, but consolidating at higher prices. Cobalt is unchanged at $23.95 per pound. Lithium is trading at $16.84 per kilogram. That is $2.77 higher than last week. So lithium's run continues, bottoming in the summer at $8.34, now more than double at $16.84 per kilogram. So lithium doing quite well. Uranium also climbing at $81.40 per pound. That is $1.15 higher than last week. And zinc is unchanged at $1.40 per pound. Zooming out, Japan's bond yields stand out, precious metals correcting, while copper, nickel, and lithium show strength. And one thinks of the car industry when you put all those metals together, and those are your metal prices. Coming up, I'm very pleased to present an all-star panel on the gold market. This one featured John McCluskey, Rob McEwen, and Rick Rule. And the title of the panel is Gold, Where Does It Go From Here? And I did the moderation. I thought it was super interesting with some very practical insights, particularly for gold stock investors. I hope you enjoy the conversation, and I will see you on the other side. Well, what a thrill to have these great guests here, true experts in the business. We're going to talk about gold and where it's going. It's at an inflection point, and so welcome everyone on the panel here, and welcome everyone in the audience to what should be a wonderful discussion. So my first question that I thought to myself as I was composing the questions for this discussion, with our gold, is it's above $4,000. And so when you have, family and friends who are perhaps interested, as I invited my mom to buy Molycorp, 15 years ago, I've learned maybe I don't give too much investment advice. But so when friends and family come to you and say, should I buy gold? Rob, what do you tell them?
If you bought it 57 years ago, you would be up 121x. on that. I still think there's more upside. So, buy.
Very succinct. And Rick, go for it.
You're asking this panel if they believe in gold. Sort of though you were in an evangelical church and you asked the choir if they believed in God. The answer is likely yes. I believe I've been through a couple periods in my life where the US dollar, the currency I mostly spend, lost a lot of purchasing power. And I think we're in that same sort of epoch. Specifically in the decade of the 1970s, the US dollar lost 75% of its purchasing power, and the gold price ran almost 30-fold. My personal belief is that the US dollar loses 75% of its purchasing power from here over 10 years. I don't think that gold goes 30-fold from here. But I do think that the nominal price of gold, which is to say the price of gold in US dollar terms, mirrors the decline in purchasing power of the dollar, which is to say that gold maintains its purchasing power while the US dollar loses 75% of its purchasing power. So a 3x increase over 10 years, sadly, I think is likely. I say sadly because gold does well in circumstances that are necessarily very bad for the rest of your life. So be careful what you wish for, folks.
Very interesting. And John, what do you think? What do you tell your friends and family?
Well, one thing I'll say is anybody who's sitting on this panel has been around since gold's been under $300 an ounce. That's about where it was when I started Alamos, when I took the option to purchase our first project. And so for us, at 4,200 gold, our dreams have come true. You know, I mean, if you would have told me even 5 years ago that by 2025 we'd be looking at a $4,000 gold price, I was hopeful, but to be living it is, that's living the dream, right? There's no doubt about that. But in terms of, where is it going to go next? It really comes down to what both these gentlemen have been saying. You know, there's by no means are we in the late stages of a gold market or gold rally. And there's all kinds of charts you can look at to back that up. And for one, is if you look at inflows into investment funds that specialize in resources, gold, and so forth, they're not coming. The money has not arrived. People are still long the S&P 500. They're still enjoying fabulous gains on the Magnificent 7 or Magnificent 10, and they have not shown up to this party. So are they coming? What will it take? I don't know. I would have thought $2,500, $3,000 gold, everybody would go, what are we missing here? And would have dived into gold. As a producer, watch our cash flows. I mean, we didn't even hit all our numbers last quarter, and we produced record free cash flow and earnings. And that was an okay quarter. It wasn't we're going to have a hit it out of the park quarter this time. But gold isn't 3,800 now. I think it was 3,600 last quarter. It's going to be 4,200 this quarter. I mean, it's unbelievable the amount of cash we're generating. And we're eventually, with those kinds of free cash flows are eventually going to attract a much broader spectrum of the investment market. So I think gold equities, if you're doing well, you're trading around 1 times your net asset value. And these are companies with growing net asset values. That's not a great place to be, despite the fact that our stocks have done really, really well. I think it's going much, much further as a market. And I think, a $15,000, $20,000 gold price, how crazy is that when you've got, $100,000 Bitcoin, and that's basically nothing, right? In fact, I think it was a great big diversion.
I
think somebody got all the idiots to buy Bitcoin so that they could accumulate gold. I think there's something to that. I don't care if you don't, but it's just, my crazy idea. But the idea that gold could go to these, what sound like astronomical levels, I think it's perfectly reasonable.
It brings up an interesting point in the sense that, we're above $4,000 and it sounds like, no, it is not time to sell. And you think of Bitcoin, the classic Bitcoin holder is buy and hold, hodl, so to speak. Is it the same mentality? Is there a point that you sell your gold? Rick, what do you think?
The last time I sold an appreciable amount of gold was in 2010. I had owned gold as a store of value, but also for liquidity. And in 2010, there were other asset classes that seemed cheap enough that I wanted to use some of my liquidity to buy assets that I thought would do well over a decade. So gold served its purpose very well for me. I've saved primarily in gold since the year 2000. I've maintained liquidity in US dollars. And I found myself in 2010 confronted by an awful lot of opportunity, enough assets that I understood the valuations of, that I was willing to reduce my overall liquidity, in hopes of buying assets that would perform well for a decade. My suspicion is that a similar opportunity will come to me in the next decade. I don't know what it'll be. Perhaps I'll die and my estate will sell the gold, but I'm hoping that I have more of a role in that decision. But sure, there will come a time. Gold is a fear-based asset. And my hope is that there will come time in this decade where my greed overwhelms my fear, and I'll sell the gold and exercise my greed.
It's interesting when I hear you speak. First, you mentioned the dollar relating to gold. In a sense, it sounds like your framework is somewhat relative, and that gold is basically an asset within a larger framework of valuation, for lack of a better term. So would you agree that that's a fair characterization of how you see things in regard to gold?
I would. I don't think there are certainties in life. I've learned that as an investor. Maybe I'm not a great investor. I think there's a range of probabilities. And
I think you are.
I organize my life around a range of probabilities. And it was very apparent to me in 2000 with gold at $250 or $253 an ounce. When I juxtaposed that to the U.S. 10-year Treasury and the rate of return that was available to me on the U.S. 10-year Treasury relative to the balance sheet and the income statement of the guarantor, the U.S. government, that I wanted to save in gold and maintain liquidity in U.S. dollars. And nothing has changed. The arithmetic of America, the arithmetic of our ability as a society to generate wealth relative to the rate at which we consume that wealth, sadly, makes me as an American much more gold-centric than dollar-centric as a saver.
Excellent. Yeah, so the argument, in a sense, persists. Rob, do you see a similar framework for yourself? Is it mostly relative to other asset values, or is there a point where you just say, this has gone up quite a bit, maybe I diversify somewhat?
The first time I really got excited about gold was in the 70s. Came out of college and got involved with the gold market, and that was in 74. It peaked right at the beginning of 74, dropped to $96. Everything crashed, and then it started its ascent to $850. And then it got up to $850, and Volcker put 20% interest rates there, and you go, well, you could double your money in just over 3 years. And I was still a gold bull at that point. And then I watched it go down. And gold, what I like about it is the 2-day liquidity. Anywhere you can get out of it. Most assets don't give you that chance to have that much liquidity quickly. But if you look at its progression, I mean, the trend's been up, as I said, it's up 121x since the US dollar became under doubt. And I think we're at another inflection point in the market where the confidence in the dollar is being severely questioned. And we could have a similar run. But I have to caution everybody, and myself, you have runs that are 4, maybe 5 years long, and then there's a bit of a correction, and then a base, and then it goes again. And when, for equity investors, I really remember a couple of times when everything just fell out of the sky, and that was the beginning of 2012. And you lost 60, 70% in the seniors, you lost in the developers 70 to 80%, and in the juniors, they went 90 to 100%. I mean, just, it stopped. And so you really have to look at this market, as Rick was saying, there's moments when you might want to take that liquidity you have and the profits and move into another area, whether it be interest-bearing or another form of technology. But gold preserves purchasing power. And that's the big appeal of it. And you're looking now, we're seeing central banks coming in and doing record purchases. And last week, and it was old news, I guess, but I was having a conversation with the Tether people, and they were going, we're buying 2 tons of gold, and almost every week. And I'm like, you are? And you start thinking, well, this digital currencies that are around the world, when are those other ones going to start doing? And the stable coins are getting real assets behind them. And that could fuel the commodity market and the gold market. So you have central banks buying, and you say, if they're buying, why shouldn't you? And that's where I do think it's going higher, and I think the trend is going to continue going higher. But there's going to be some corrections in there. And something like Rick, I just took a chunk of my change and just dumped it into bullion and feel that's a comfortable place to be. I'm also in a lot of juniors, but I like being able to move in and out quickly if I want to, have that opportunity.
Well, there's an old world view on physical gold. It was espoused by this gentleman I knew in Geneva named Alain Etienne. Unfortunately, he passed away during COVID. But he managed some of the wealthiest people in the world. He managed their portfolios. And what he would do is take 10% of the profits that they made every year on their investment portfolio, and he put it into physical gold. And he did that every year. And some of the older investors that he'd been working for many, many decades passed on, and now their kids inherited all that wealth. And when he sat down to speak to them about what to do, their first idea was, well, why don't we just sell this gold? And he goes, we'll never sell the gold. He said, that gold is for a time that you have never seen, and may you never see it. But their idea was that this was an intergenerational asset, that the gold should be accumulated as family wealth, and if things were peaceful, if you lived through your life and everything was peaceful and there was no upheaval, then you pass it along just as the father and mother passed it along to those inheritors. And they never sold their gold, right? They had other investments, but that component of their wealth that was in gold was saved for a time, like an insurance policy, for when gold will be the only thing that really matters. I thought it was a very interesting viewpoint.
Yeah, unfortunately, history confirms that that is often the case. It has over history repeatedly, let's put it that way. It is interesting how you mentioned that, though, because it is a long-term view. And so bringing it to our recent run-up that we had here, as I was telling Rick yesterday, we were at $2,600 gold a year ago when we last talked. John, not to ask you to time the market too much, but do you feel like we've maybe accelerated a little too quickly here, or not?
Well, the world's moving very quickly, and I think gold is moving with it. Look what's happened since the election of Donald Trump and this new American administration in 9 months. It's really dramatic, some of the things that are taking shape. And if you think they're all good, then you're reading different newspaper than I am. I try to read a wide variety of press because it's all become so compartmentalized. You've got the left-wing point of view and the right-wing point of view, and that I don't think there's any truth to be found in either source. I think you have to ultimately develop your own view by observing what's going on and picking up as much intelligence as you can. It's probably more important to do that now than ever before. But my view is that you've got to be very nimble in this world. And I've had this strange, foreboding about the direction things are taking. It's as if, this security that had been provided by a U.S. hegemony has essentially been withdrawn. And where does that leave the world? I'm not quite sure. But I know that militaries, whether it's German or Italian or whatever, they can't react fast enough. They can't invest this 5% of their GDP in military, because I don't think militaries can actually generate or produce the military hardware to meet that demand, for one. I don't think it's going to be easy to recruit young people into these armies, for two. I mean, talk to the people that are trying to do that in the Ukraine right now. All the real gung-ho young men, 300,000 of them roughly, have already been killed. And nobody's, that willing to step up and be the next one in line. So, I mean, where is this all going? It's not heading in a really good direction, but, are we hearing sort of the distant drum beats of war right now? I think we are. And if the world moves in that direction, I would definitely want to be holding on to some gold if I was an investor.
Indeed. I think of my family going back a couple of generations, or at least to World War II. Rob, you've run a gold company. What are people not thinking about when investors are considering buying a gold stock? What are the sorts of things that they maybe should be thinking about that maybe they aren't thinking about?
Top of the list. Do they sell royalties or streams? Did the CEO do any math when he went through school? It's looking at it and saying, are they saying the price of gold's going up, but we're selling part of our revenue? They'll come back and say, well, we didn't have to dilute. We didn't have to issue any shares. We sold this. But the problem with a stream and a royalty is they go on forever, and it takes away a lot of the resilience in a company if there's a downturn in the market, because you could sell those other products. I think owning a royalty or a stream is a wonderful place to be. And you should go find the miners that will sell you one and then sell their stock. But the royalties and the streams sit above all the waves that occur on the sea of mining. And you have labor issues. I went through a 46-month-long strike when I was running Goldcorp. You have ground falls. I mean, you look at Freeport, McEwen, and the mud inflows into their mine recently in Grasberg. There are all sorts of things that come out of nowhere. So you want to look at it. Some people will say, I want a strong balance sheet. I want long life. Those are both really good things. I don't want much debt. But sometimes you have to look. I used to find when I was managing mutual funds and closed-end funds, people come in and tell me their story. And at first, some people would walk through the door and I'd say, I don't want to listen. I'd close my ears. There was just something about it I did not want to. And then after a while I said, no, you've got to listen to this. And I keep my door wide open and I try to listen to all the stories, because there's some people that you might not, first impression, say no, but they are out there digging, they're probing, they're persisting. And there are a couple of fellows that were serial discoverers or recognized that they didn't carry a good reputation when they came in, but they certainly did very well identifying stories that became quite valuable. So try not to put up too many screens when you're hearing stories in the junior space. But I think it's necessary to look. Don't pick one story and think that's going to deliver your home run. You need multiple.
I love the subtlety of your answer there. Don't put up too many screens in the stories that you hear about juniors. I love that. Rick, I think one of the temptations, at least from my own perspective, I think other people have had it, other retail investors, is to be what I'd be tempted to call, to be too clever by half. I'm going to buy gold, and then when gold goes up, I'm going to rotate out of gold, and then I'm going to buy silver, because that hasn't moved yet, and we saw silver just moved. And then, okay, maybe silver moved, and maybe I should buy copper or something else. Is this a good strategy? Do you do this? Or is this something that is, again, too clever by half?
I think too clever by half. I'm not a trader. My time frames, it's odd, my time frames have become much longer as I have less time on Earth. When I was a youngster and had all kinds of time in front of me, my expected time frames were very short. Now that time is tight, I've become much more patient. Not because my time preference has changed, but because I've been on Earth long enough to know that short time frames don't make big money. Long time frames do. And so attempting to cycle or trade through the market doesn't play to my strengths. My strengths are that I have the courage and the discipline to buy stuff when they're out of favor, and I often have the discipline to sell them when they return to favor. That's sort of what I do. And if I might, I want to react to what Rob said, just so for fun we can have some tension on the panel. I think if you invest in junior, you have to put up lots of screens as opposed to very few screens. I believe if you look at the length and breadth of the junior mining world, 3,000 public companies worldwide, probably 2,500 of them are valueless. I realize that's an unpopular point of view. What's nice about the sector is that the performance over time is so putrid that gross performance causes people to overlook the fact that 10% of the listings generate so much utility, so much return, that they add credibility and occasionally luster to a sector that is otherwise pure shit. And it's really about stock selection. Mm-hmm. So where he says don't put up too many screens, I would say put up a lot of screens.
Mine's on the front door.
Okay. What I've learned is that Pareto's law works. There are a few people in the world who have been kind enough to make me all of the money I've made. All of it. And if I had in my 30s, never done business with anybody who hadn't made me money by the time I was age 35. I would have worked a quarter as hard and made twice as much money. So I would say, with regards to the juniors, put up all kinds of screens. The second thing that Rob said is very useful. Everybody in the room has to listen to this. You've had a hell of a year, great year, and you deserved it. There will come a time when the gold price will fall precipitously and the gold mining stocks will fall further. But that won't be the end of the market. It'll be a shakeout like we had in 75. In 75, the gold price fell by half. Mm-hmm. As you said, the miners magnified that loss. And people who got shaken out, and there were many, missed a 5-year move from $97 at the bottom to $850 at the top. So think of this as a rodeo ride. Think of yourself, if you're going to play the game, you got to be persistent and you got to be tenacious. And also think, and this is really boring, if you don't have an opinion as to the value of an investment, the price is meaningless. The fact that something is 50 cents a share, if you don't know how many shares are outstanding, whether they have debt, what do you matter? What does it matter if it's 50 cents? If you don't have an opinion as to value, you're going to get shaken out by price. So worry about determining from your own point of view what the value and what the expected value is. And then price becomes an opportunity for you, not a risk. Sorry for pontificating, but
Thank you, Rick. Thank you. John, I'm curious. I mean, we see oil is fairly low. Last I looked, a few days ago, it was around $55, $56 a barrel. Does that factor in when you're considering the gold price or considering your business? How does the price of energy factor in to the gold price?
Well, it depends on how reliant you are on fossil fuels for your operations. Unfortunately, we're not that reliant. It's not a big part of our cost structure. You know, we operate, primarily our production comes from underground mining operations in Ontario. We're tied into the Ontario power grid, which drives, that's the majority of the power that we use, basically to hoist ore to surface. And as a result, we're reliant on hydroelectric power and nuclear power. That's primarily how power is generated in the province of Ontario, which makes for greener operations, if you will. The story of the guy thinking he's doing really well, plugging his electric vehicle into a filling station that's ultimately powered by a coal-fired power plant down the road. I mean, how green is that, right? I mean, we've all heard that story. That's a big advantage that Canadian operations in places like Ontario, Quebec, Manitoba, they're enjoying a greener sort of source of power, if you will, because it's largely generated not through carbon power sources, whether it be coal, oil, or whatever. So what I would say, though, I'm just sort of picking up where Rick left off. I've been playing that game for quite a while. In fact, I recall Rick was one of the first investors I ever spoke to going back to like 1983 when I was starting at Calamus Gold. But by the time I started this company in the Alamos in the early 2000s, we were 5 cents a share. If you just bought our shares and held them, you'd have done pretty good. We're trading at $52 a share now. But it was, just as you said, it was a bit of a roller coaster ride. But there was a way to take advantage of every part of that cycle. So what did we do at the beginning with gold under $300 an ounce? We took an option to buy mulattoes, which we bought for $8 million. That's gone on to generate $750 million in free cash flow and growing. When the gold price ran from the time we took it into production in 2005, the gold price kept on going up right to almost 2012. We generated amazing profits from our operations. But when everything came crashing down, we didn't do big acquisitions at the top of the market. We kept our powder dry. When the cycle collapsed, 2015, 16, and 17, we made 3 back-to-back acquisitions, bottom of the market. Paid almost nothing for those acquisitions. Those 3 acquisitions that we made, I think collectively they're valued in the market right now at roughly $12 billion. So we probably paid about $2 billion in acquisition costs. In other words, in the down cycle, if you're an operator and you know what you're doing, you take advantage of that cycle. You make acquisitions. Now it's cycled up. What have we been doing during the turn? We've been drilling like crazy. We found 8 million ounces in the last 6 years at a finding cost of roughly $30 an ounce. And now we're sort of moving at a point where, we're investing the capital to expand these operations, and then we're going into harvest mode. I mean, that's just the way you play it. It is a cycle, right? And smart investors have been making tons of money by investing in that cycle. If we could only have more smart investors, gold mining CEOs wouldn't be forced to do acquisitions at the top of the market, right? They'd be able to do them at the bottom of the market. And like myself, when I did them at the bottom of the market, they wouldn't be just vilified by the investment community for having done a bottom of the market transaction. So I welcome more people to get smart about what we're doing in this sector. As we're not talking about gold now, we're talking about trying to be in the gold mining business. And, Rob may be one of the most successful mining company creators, investors that we've seen. And I don't think you've played it any differently.
Well, I beg to differ. I haven't had the run that you had.
But you've had to work counter-cyclical in order to
I like buying
in order to create value. And I think more investors need to get onto that counter-cyclical bandwagon, because we've just been saying gold is cyclical. So that's how we're going to make money.
And on that point, I mean, Rob, have miners been too cautious in the last, 15 years? Of course, around 2010, companies were accused of overspending, and fiscal discipline was the order of the day for the next 10 years. Has it turned into too much caution?
Yes. But if you look at the majors, they seem to get the market timing wrong. They talk about where gold's going, but then their actions in the past, they would hedge. So it caps the upside. Now you have prime examples of Newmont selling the Porcupine assets in Timmins and Barrick selling Hemlo. And you're saying, now what's going through their heads? The price of gold's going up. Aren't they believing that? And they're selling off assets. I mean, the deal on, I think, Tony McCooch, when he bought the Timmins assets in Newmont, stole them. The deal was at $2,200, and now gold's at $4,200, 280,000 ounces of gold. Now, here's the situation. He sold to a royalty company, 2% on that production. I probably wouldn't have thought about that. But he sold that. He borrowed 100, basically said there's 150, and he gave away penny stock for 75 million shares. And I thought, this is almost like Gold Strike. When Barrick bought Gold Strike for $40 million, that was shopped all around the street, and no one wanted to touch it. And the two largest gold miners in America, and some of the largest in the world, were on either side of that deposit. And they couldn't see value because they were open pit miners, and this was an underground story, even though there was 1 ounce down there that they were in their drill results, and it was sulfide. And they didn't know how to think about dealing with it. And there was a technological change that came along. Barrick had bought an autoclave when they bought a mine called Mercer, and they came and said, well, we could treat that ore. So there's technology that comes along every once in a while that alters the game in a big way, like heap leaching was one. The autoclaves allowed you to get in there. But I just think the majors, I mean, I used to be very critical of them in the 70s and 80s when they were hedging, in the 80s and 90s, because I just said, why are you giving this away? So I'd say it depends where you are in the scale of companies. If you're in a major, you're probably going to get a Bay of Pigs thinking. You've made a decision, you go ahead and you don't care about what's happened in the world. Down at the levels for John, and I'm a little below that right now, you're looking for opportunity and trying to sit on your dollars and get the most value for it.
For me, the funniest story in that regard is Barrick selling Malartic for $35 million to McWaters. McWaters went broke, and Sean Roosen bought it from the trustee in bankruptcy for $80,000. What is it worth now? I know they're producing 600,000-700,000 ounces of gold. It's a Agnico Eagle primary asset.
Flagship.
Yeah. And similarly for Detour Lake, probably the biggest gold deposit in Canada. And I think Barrick tossed it off the back of the truck for a few $1 million. And now it's another flagship asset for Agnico Eagle. I mean, what are they thinking? But you can depend on them to do it. Bottom of the market, okay, line up, everything's for sale. I don't know why they do that, but may I never be a major.
Be careful what you wish.
Yes, exactly.
I never want to be.
As we start to wrap up here, we have a few minutes left. Rick, do you see gold stocks as undervalued then?
Selectively. I think if you buy the class, you'll go broke. I think there are high-quality companies within the sector. And I think if you buy the high-quality companies within the sector, in the next decade, if you're patient and if you're tolerant for volatility, you'll do extraordinarily well. I'm reminded of the decade, well, actually 11 years, 2000 to 2011. Pretty good gold market. And if you look at the then equivalent of the GDX, Philadelphia Gold and Silver Stock Index, in that 11 years when the gold price ran eightfold, the free cash flow per share of the Philadelphia Gold and Silver Stock Index declined. It took real skill to have lower free cash flow per share when the selling price of your product ran eightfold. Don't buy the waterfront. Don't buy the industry. There are some very established valuation metrics. There's enough data now to look internally at corporate cultures because the management teams have been intact for a decade so that you can measure things like exploration efficiency and recycle ratio. Commercial for the Rural Classroom. If you don't know how to do it, I teach it for free. ruralclassroom.com. Don't buy the waterfront. If you buy the best of the best, 10 years from now, you're going to be really, truly surprised how much money you made. If you have the guts to be patient and be persistent. If you don't, do something sensible with your money.
Buy Bitcoin.
Whatever.
Just kidding.
Whatever. Something you understand.
Yes.
Paper route or, whatever.
Speaking of expensive, John, you seem to be saying early in our conversation that gold stocks are undervalued. Is that correct?
Well, here's a metric. You talk about metrics nobody uses anymore. This is one that J.C. Potvin was famous for. How many ounces of gold are you getting per share that you're buying?
But that doesn't take into account the cost to produce them or when you're going to
I
produce them.
know, but I mean, if you're looking at a decent company we're producing gold at roughly $1,400 an ounce, and it's priced at $42. Those are great margins. But how long can you keep that up for? That's a question. And how many ounces of gold are you getting per share? That's just one of the things that I never hear talked about anymore. But we used to have some analysts on Bay Street that this was one of their calling cards. This is one of the things. When I used to get a call from J.C. Potvin from Burns Fry at the time, this is one of the numbers he wanted to get at. And I just did that this morning because I was talking about it with somebody. And I took our 430 million shares outstanding because we've issued a lot of stock to make those acquisitions along the way. But we've added a lot of ounces. So I took the 25 million ounces that we have and I divided into that and it came up to 17. We've got 17 ounces of gold for every share we have issued. I don't think I've ever been associated with a gold mining company, including this one 10 years ago, that anything close to 17 ounces of gold per share. And that's real value. And if you add it up, what's 4,200 times 17? That's $75,000 US worth of gold for every share we have issued. Now, it's going to cost us money to get it out of the ground, and we got to pay taxes and everything else. I get that, but it's still a big number. And if you ask, can you find value in the gold sector right now? I don't think we're alone in that. I haven't done that calculation across, the sector, but I'll bet you'll find that there's a lot of companies out there with phenomenal deep value. I think there's tremendous money to be made investing in this sector, not trading in and out and speculating. You can do that across any sector. I think the gold sector is a great place to invest right now.
Rob, final word to you. Are gold stocks undervalued?
Gold's going up. Gold stocks are, on a relative basis, they're cheap.
Rob McEwen, Rick Rule, John McCluskey, thank you for joining us for this wonderful discussion.
Thank you.
Thank you once again to Eloro Resources for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit elororesources.com. And thank you to the Gold Panel who appeared at the International Metals Symposium in London. It was a delight and an honor to host that panel with such esteemed individuals from the mining sector. And thank you, dear listener, for continuing to support this program. I've received messages in the last week from people who enjoy the show, and I just want to say I really appreciate hearing from you. A happy holidays and a happy new year to all. We will see you in 2026. Until next time, take care.